Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you so much for joining us as we go over a few of the topics we had in this week's investment allocation meeting. Before we get into that, I'll say our thirdly invites have went out, so hopefully you've had that a chance to click, and hopefully you're able to join us or at least see the electronic version that we send out once we're done. So again, look for those in your inbox and click on it. Let us know if we could expect you. This week, we'll be talking about jobless claims as we look at an important employment report later in the week. And then Andrew's going to cover some seasonality topics looking at September and the election. So let's dive right into jobless claims, a key piece of the employment markets. Now, later this week, on Friday, is the first Friday of every month, we get the Department of Labor's employment situation report. That is the most widely watched report. It gives us the unemployment rate that feeds in that the Fed talks so much about. One thing we pay at least as much or maybe more attention to is the jobless claims. Jobless claims are those initial filers for unemployment insurance and is really the first mover in any employment cycle. Before you have like a wave where you have new additions or new payrolls, is really the start of an uptick for people filing unemployment. That is really a leading and early indicator. And as you can see from the chart here, this goes back over a very long period of time. And notice one thing that each of these cycles have in common. They don't tend to tick up or trend up smoothly. They spike, which should make some sense once you start to have some mass layoffs. That begins to alert consumers, alert businesses to get a little bit more conservative, pull back, which produces more layoffs, and we kind of have that virtuous cycle take place. So where are we today? We are off really generational lows. We spiked up during the COVID era, but then really remarkably regained those jobs very quickly, and then bottomed around these really generationally low levels of unemployment insurance, which is a sign of about as healthy of a labor market as you could possibly have. But over the last few months, we have seen that tick up to 231,000 for each Thursday that this report comes out. So this has got more of the attention of the Federal Reserve, is in one of the reasons why they're very likely to pivot to a rate cut here later this month. We'll see how this feeds into the employment report, which is, again, the bigger, more widely watched tone here. But any sort of continued uptick will begin to get more attention from that Fed and likely to cause them to be more aggressive. So as we just come off of Labor Day, we wanted to give that strong focus to labor, especially because it has got all of Jerome Powell's and the Fed's attention for right now. So again, we're kind of hovering around these lows, but the short-term trend has been up, and something we'd love to see cool off before it begins to spiral out of control. So that's the economics. Andrew, will pass the baton over to you to hit market seasonality.
All right, thank you, Adam. So as we close out August, we shift into September, which for the market, probably one of the least favorable months that traders look forward to. And the reason for that is historically, when we look at seasonal trends, September has been a much rougher month for the equity market. Now, the major caveat, the big caveat we want to get right off the bat is market seasonality is important, but there's nothing that requires the market to follow any seasonal path. We just want to understand, is there any type of patterns to how the market trades during different times of the year? And so if you look at the bottom part of this, the first chart I'm going to show, we can see the average performance since 1970 for each month for the S&P 500. You can see one major trend, a lot of them are positive. In fact, most of them are positive except for one. Unfortunately, that one's September, as we now are moving into it. And so historically, since 1970, it's been a little bit of a coin flip. It's not as if every September is down for the equity market, but we have seen an average decline of about 0.9% in the month of September. Then we can take our magnifying glass and zoom in on the month of September, and that's what's on the top part of this chart. And that's showing the average performance for each trading day in September. And why this is important is we want to understand, okay, historically, September can be a rough month. Is there certain parts of the month that typically show that weakness more than others? And that's exactly what we see in September. You can see the first part of the month, we see a little bit of gyration, a little bit of back and forth, some big up days, some down days. And it's really towards the end of the month is where historically, is when we start seeing the most of the weakness that causes September to historically be a negative month for the market, as comes in towards the back half of that month. And what this sets up for, and when we look at the bigger picture again, is historically, especially in election years, which we'll get to next, October, November, December, still very, 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 very strong. You can see actually November and December are some of the best performing months for the equity market. And so we have to recognize that when historically September can be down, why this is important for the allocation team is we want to understand do we follow these trends? We wouldn't be surprised if it started to snow in Indiana, or at least where we are in Indiana, in December. And so just like that, we don't necessarily never go outside in December because it might snow. We understand the type of environment that we're in, and we may need to wear certain clothing, bundle up, wear a coat, put an ice scraper in our car, prepare for that type of environment. The same is for the market. We understand that historically September can be a rougher period. Do we start to see the market follow that trend and not be surprised or caught off guard if we see some very short term type weakness that historically gets to lead into a very strong period of weakness into the back half of the year? And so this is something that we take into account. We view this as kind of a secondary set of data. And again, the market isn't required to follow this pattern, but we need to understand what can be typically occur in the month of September for the equity market. Now, if we look going back to the election cycle, and something we've talked a lot about. Last year, we looked at this extensively. If you were watching the market carver in August of last year, we talked about in pre-election years, traditionally start seeing some weakness around August and September. And that's what we saw, roughly about a 10% decline last August and September because of that election cycle. Now, we continue to follow the election cycle, looking now at election years. And typically in election years, we do see that seasonality for September play into election years as well. And if we look at all the past election years, dividing them up into over the last 5 years, that gives us our gray bar. The last 10 years gives us that black line. And then we look at all the data, which gives us the blue line. What we can glean is typically election years are actually pretty positive for the equity market. You can see in that blue line, it's very, very positive, almost up to about 8% return looking at all election years. Now, when we start looking a little bit closer, the last 10 years, the last 10 years, last 5 years, that's where we get a little bit less of a data sampling period. But we can see that traditionally we do see some weakness in September and see the market fade a little bit more into October and see a bottom around those October time periods, seeing the market then rally through the election period of November and December. And so the market's not required to follow these trends, but it's important to understand how history does have an impact on the market. There's a famous Mark Twain quote that history doesn't always repeat, but it often does rhyme. And so we are aware that there can be some weak periods, some weak trends in this time of year annually, and then also for election cycle years as well, that the market can have a little bit of a rough period. And we can make adjustments as we see fit within the portfolios, understanding the type of seasonal period that we're in right now. And so the main point and takeaway from here is not to scare anyone that the market may drop in September or October, but to recognize this is not to be afraid or be scared if it actually does occur. And understand this is a normal part of the market cycle, and it typically leads into a very strong period of the market as we finish out the year and get excited then for 2025. And so this is just one of the many pieces of data that our allocation team takes a look at, evaluating every day and every week to make sure we're properly allocated and properly positioned across the portfolios that we're honored to be taking care of.
Oh, great. Thank you, Andrew. As always, so well done. And thank you to all of you for giving us your time. We'll give you a reminder here. If we can be of service in any way, please give us a call, 800-928-4001, or scan the QR code and book us electronically. And once again, thank you. Have a great weekend.